Let us solve a question on the calculation of GDP at market price. The question is given GDP at factor cost is 32,509. Net factor earnings from abroad is minus 249. Depreciation is 3,792. Indirect taxes is 3,162. We need to calculate the GDP at market price. Okay. Now the formula is pretty simple. That is GDP at market price is equal to our GDP at factor cost plus indirect taxes. Okay, let's write it as IT minus subsidies. Okay, so S denotes the subsidies, IT is the indirect tax, GDP FC means GDP at factor cost. Okay, now you can see here. So we need GDP at factor cost, correct? Net factor earning from abroad, we don't need that very term in calculating the GDP at market price. It is used when we calculate the GNP. Okay. Depreciation, we have nothing to do with this. It is used to calculate the net. Okay. Net, gross domestic product, or net national income. So we don't use depreciation here. Indirect taxes, yes, this is our choice variable. So our GDP at market price will be equal to factor cost is 32,509 plus indirect taxes 3162. Now add them up. This comes out to be 9 plus 2 is 11. So 6 plus 1 is 7. Then we have 5 plus 1 is 6. 2 3 comes out to be 5. Then we have 3. So this will be our GDP at market price. Okay, so GDP at market price is affected by two variables, you can see. So GDP at market price, okay, is affected by the indirect taxes, okay, which tend to increase the price. Okay, so indirect taxes will increase the price of a product, let us say. And then we have the subsidies. Okay, subsidies, and they tend to decrease the price of the product. Okay, together these two, when we add the indirect taxes and subtract the subsidies, we get the GDP at market price. I hope I make myself clear. Thank you.